Imagine waking up one morning and realizing that the money you've been carefully saving for decades might not grow the way it used to. For millions of Americans, that moment isn't hypothetical anymore, it's happening right now. The old formula of work, save, invest in stocks, retire is being challenged by rising inflation, market volatility, and a growing sense that traditional investing alone may not be enough. That's why a massive shift is underway, as everyday investors from young professionals to retirees are increasingly turning toward alternative assets like crypto, real estate syndications, and even digital collectibles to protect and grow their wealth. For decades, traditional investing has been built on a foundation of stocks, bonds, and retirement accounts like a 401k or IRA. These vehicles are regulated, widely understood, and backed by long-term historical performance. The S&P 500, for example, has delivered consistent returns over time, making it a cornerstone of American wealth building. Financial advisors have long recommended diversification within this system, balancing equities with bonds, adjusting risk based on age, and optimizing tax strategies under IRS guidelines. It's a system designed for stability and gradual growth, not sudden windfalls. But here's where things start to shift. The economic landscape has changed dramatically over the past decade. Inflation has eroded purchasing power. Interest rates have fluctuated unpredictably, and younger generations are entering the workforce with a different mindset. They're more tech-savvy, more open to risk, and less convinced that traditional systems alone will secure their financial future. Add to that the rise of fintech apps and zero-commission trading, and suddenly investing feels more accessible but also more complex than ever before. This is where crypto enters the conversation. Cryptocurrencies like Bitcoin and Ethereum have introduced a completely new asset class that operates outside traditional financial institutions. There's no central bank, no closing bell, and no geographic limitations. For many Americans, crypto represents both opportunity and uncertainty. On one hand, it offers the potential for high returns and acts as a hedge against inflation in the eyes of some investors. On the other hand, it comes with extreme volatility, regulatory ambiguity, and a steep learning curve. What's interesting is that most Americans aren't choosing between crypto and traditional investing, they're blending the two. This hybrid approach reflects a deeper understanding of diversification. Instead of putting all their money into a 401k or all into crypto, investors are spreading their risk across multiple asset classes. It's not uncommon now to see someone with a traditional brokerage account, a retirement fund, and a small percentage allocated to crypto or other alternatives. This strategy aims to capture growth opportunities while still maintaining a safety net. Another key driver behind this shift is trust, or in some cases, the lack of it. After events like the 2008 financial crisis and more recent banking uncertainties, many people have become skeptical of centralized systems. Crypto, with its decentralized nature, offers an alternative that feels more transparent and independent. At the same time, traditional markets are still seen as more secure and regulated, especially when it comes to long-term retirement planning and protections like FDIC insurance or SIPC coverage. Tax considerations also play a major role in how Americans are navigating this new landscape. Traditional investments often come with clear tax advantages, such as tax-deferred growth in a 401k or tax-free withdrawals in a Roth IRA. Crypto, however, is treated as property by the IRS, meaning every transaction can trigger a taxable event. This adds a layer of complexity that many investors are still trying to understand, especially as regulations continue to evolve. Risk tolerance is another factor shaping this trend. Younger investors, who have more time to recover from losses, are generally more willing to allocate a portion of their portfolio to high-risk, high-reward assets like crypto. Meanwhile, older investors tend to stick closer to traditional assets but are still dipping their toes into alternatives as a hedge. This generational difference is creating a more dynamic investment landscape where strategies are constantly evolving. Technology is accelerating all of this. With just a smartphone, anyone can buy fractional shares of stocks, invest in ETFs, or purchase cryptocurrency in seconds. This level of access was unimaginable just a couple of decades ago. It's empowering individuals to take control of their financial future, but it also requires a higher level of financial literacy. Understanding concepts like asset allocation, market cycles, and risk management is more important than ever. At its core, the shift toward alternative assets isn't about abandoning thrift